Now, very similarly to what we saw earlier with the team points analogy, we can use this accounting equation framework to prepare statements. In this case, financial statements, the balance sheet and the income statement. Now let's start with the balance sheet. What is the balance sheet doing? Well, that is showing us the financial position as of a point in time. And here we've chosen to say that the point in time we're interested in is April 1st. So the balance sheet starts with the total assets, the 1,700 here, and it presents that at the top, assets. Then it looks to the right side of the accounting equation and says, hey, as of April 1st, what were liabilities? They were 500, so it puts that next. And then it's interested in showing owner's equity. So it's got to pull from this owner's equity account here, and it's going to pull from each of these four buckets or accounts. So each of these numbers are pulled, and they're pulled all the way down here, and they feed into this 1,200. When the 1,200 and the 500 are added together, we get something called liabilities plus owner's equity, and that's 1,700. And of course, the 1,700 here equals the 1,700 up here. And like we talked about earlier with the points analogy, all we're doing is taking the left side of the accounting equation and presenting it on the top. And then we're taking the right side of the accounting equation, we're presenting it on the bottom. But since we have, in each of our transactions, we have recorded the same amount on the left side as we did on the right side, so that the accounting equation is always in balance, we always expect the top side to equal the bottom side, just as we expect the left side to equal the right side. So that's basically the balance sheet in a nutshell. Now, kind of like we saw earlier in the team points analogy, we can zero in on just one piece of this information over a period of time. In this case, January 1st through April 1st. And we can say we're not really interested in monies that owners have put into the business and taken out of the business, but we are interested in revenues that we've received from customers and then expenses that we've paid out to vendors. So over this time period, we have 600 in revenues, 400 in expenses, and we can present those on what's called an income statement, and that's going to show us financial performance over this period of time. The 600 in revenues minus the 400 in expenses gives us a $200 net income for the period. And this brings us to our next learning milestone. An income statement shows financial performance, revenues, expenses, and net income over a period of time, whereas the balance sheet shows us financial position, assets, liabilities, and owner's equity as of a point in time.